I think that anybody who is basing their decisions around politics, and in this case Trumponomics, I think are probably making a big mistake. What I found historically is that even the most effective presidents barely get half of what they campaigned on through Congress in terms of legislation. We don't really know which half is going to get through. Will it be deregulation? Will it be the tax cuts? Or will it be anti-growth immigration reform? So it's still early, but there's still a lot of risk and a lot of uncertainty around what Donald Trump is going to do. Really, I think the thematic that you want to follow in your decisions should really be around convictions surrounding the themes that would be in place no matter who took office. The question they ask me all the time, the first question, is where's the Canadian dollar going? My sense is that if Trumponomics, you can build a case that these trade issues are going to keep the Bank of Canada on hold for longer as the Fed raises interest rates, means downward pressure on the Canadian dollar, well, that's just going to be a further boon to our manufacturing sector. I think it's a cup half empty, cup half full story. I think that as far as the energy patch goes in Alberta, we have bottomed out. But $50 in WTI is not going to be precipitating new investments in the Canadian oil patch. I think that will stabilize. We will not have much of the way in growth in this particular part of the economy. The shale situation in the United States and where their break-even levels are, there's much more visibility for energy capital spending in the United States than there is in Canada. Good news is that we've bottomed out. I think that the oil price is probably going to stay at least close to a $50 level. That's good news. But Alberta is probably going to have to do what Texas did after the oil price debacle of the mid-1980s and find a way to reinvent itself and to diversify its economic base. It's not clear that Donald Trump is going to get through his tax cut program. As he said, governing is complicated. Well, Ronald Reagan knew that too. It took him 5 years to get tax reform through and had much higher starting levels on the top marginal rates. Well, you know, the question becomes how effective is the tax policy going to be if it blows a hole through the U.S. fiscal deficit? I mean, the estimates that I've seen are showing that the tax cuts are going to cost the Treasury $5 to $6 trillion over 10 years. How's that going to be paid for? And if it's paid for by ever-rising deficits and an ever-rising debt-to-GDP ratio, at some point you will pay the piper. At the expense of causing an already bloated balance sheet in the United States, making it more bloated, I don't think that's the answer for economic progress. I think that the tax cuts in the United States, if they are revenue neutral, that's a different story altogether. But remember, Canada went through corporate tax reform years ago under Mike Wilson and then again under Chrétien and Martin. So we're already there. And you take a look at Canadian federal debt to GDP, it's barely more than 30%. Where's it in the US? It's 80%. So you tell me, which country has greater fiscal flexibility? Risks run both ways. This could end up being a positive for Canada. Like if someone could convince me that NAFTA was a great thing for Canada, I'd say, oh, you know, please don't rewrite it. But maybe this could be great for Canada. Before NAFTA, people tend to forget before NAFTA, we had a $9 billion trade surplus in goods and services. Okay, we now have a deficit of $48 billion. You take a look since NAFTA was passed in 1994. Canadian GDP growth has averaged 2.5% per year. Guess what? Exports have subtracted 20 basis points per year off that number. So someone explained to me, NAFTA has benefited us to what extent? I mean, it's benefited Mexico. If you remember, the free trade agreement was all fine and good. If you remember, actually, that was its own source of consternation at the time. But who in Canada wanted NAFTA? We were dragged in. We could not be excluded from those talks, but that was really between Mexico and the United States. It's interesting, we have a U.S. government that is saying, you know, we can't run deficits anymore. We're not going to run deficits. Well, I don't know. I mean, trade works both ways. You have a trading partner. Do you know how many sectors that we actually have deficits with the United States that maybe we should be talking at the table? How are we going to address our deficit in the United States in, say, chemical products, or say shipbuilding, or say railway equipment, or say electronic equipment? You know, there's a myriad food and beverage products. As an example, newspapers, and reading material, books. There's a wide range of things we can sit on the table and say, hey, we're not happy with our trade deficit with you. How are we going to rectify that? The risk is the U.S. going more protectionist. We really do have to diversify our trading export exposures globally. And it doesn't just mean a focus on China, but it also means a focus on Eastern Europe, a focus on India. India really has become a leader in terms of economic growth under Modi, and his reforms are working. You know, that's the first thing I would say, is that we have to diversify our base. We also have to more rapidly develop the knowledge-based economy, technology. That actually is working well. We are actually developing you can almost call it a Silicon Valley North in that Kitchener-Waterloo corridor. But we have to do more to harness entrepreneurship and risk-taking. I'd say that the one thing that I really liked in the federal budget was just these 5 pages on the global skill strategy. And the one thing I think that Ottawa got, and it comes at no cost, is the realization that what goes into GDP, what goes into the economy, are 2 things: productivity and people. Now, we should basically not punish productivity by taking tax rates up any more than we already have. Productivity moves glacially, but people. And what's interesting is that in mid-June, the Canadian government is going to start to fast-track high-skilled immigrants into the country. That's why we might not see this collapse in home prices in Toronto. Well, we may well find that more immigration, and 40% of the immigrants come to this neck of the woods. But they're a big driver of the economy. At a time when the Trump administration is restricting H-1B visas, and at a time, of course, where there's all this uncertainty and risk surrounding, will Brexit become Frexit? If it doesn't, you know, these anti-establishment, pro-national sentiments overseas are not going to go away overnight. There's a lot of European interest in Canada as well. So you see what's happened here, because risk runs in both directions. This is where risk is an opportunity, as you had said, is that a lot of the instability around the world is actually great news for Canada, because, you know, whether you like the federal government or you don't like the federal government, or you don't like the Ontario government, the reality is how we are viewed globally. Now, I know it's not reflected in the Canadian dollar, but the reality is that we are viewed as a sea of stability in a world awash with instability. And Canada, and especially in the GTA, we are viewed as a stable and secure and safe place, not just to do business, but also to live. So I think certainly from a demographic standpoint, Canadian growth, the risk is that we will surprise to the upside at a time right now when expectations are so low. We had an event in the past 12 months that nobody talks about. Bigger than Brexit, bigger than the Italian constitutional vote last December, bigger than the US election, in my opinion. And that's the first of the baby boomers. That's 78 million pig in a python that's driven everything in the past 6 decades, from politics to economics to finance. And that is where the power and the wealth still resides. The first of the baby boomers, this wide swath of the population, turned 70. And there will be 1.5 million boomers turning 70, 1.5 million each year for the next 15 years. So you understand what I'm saying. There are things out there that are going to transcend Trumponomics. Well, what makes this interesting from a market standpoint is, whether you know it or you don't know it subconsciously, is that when you turn 70, you do the most profound asset mix shift in your own portfolio since you were in your 30s and got your first job and could load up on equities. You turn 70, and you become more conservative. You trim your equity exposure, build up your bond exposure. And it's not just becoming more conservative, it's that what you need as you get into these golden years is you need recurring and reliable cash flows. It becomes really more of an income-oriented portfolio. Well, it used to be that the good old government bond market used to give you that reliable income. But we have a situation now where almost half of the world's government bond market trades at a yield below 1%. That's going to be tough to live the last 15, 20 years of your life on. And so what's happened in the equity market is the dividend yield, dividend theme story, payout ratio story, net cash free yield story, that hasn't gone away. The stock market today, when you look at dividend growth, dividend yield, and it's not just in utilities and telecom, it's not in the old boring stocks. You have companies out there, IBM, Intel, Cisco, look at GM, an old economy, pays out almost a 5% yield. And so it used to be a time 10, 20 years ago, a lot of these companies outside of the traditional boring utilities and maybe the banks and the telecom, They were the dividend providers. Now, practically every sector of the stock market pays you a dividend yield that's better than what you'll get in the mid part of the government bond market. And that's something that's brand new. So that's something that CEOs and CFOs have figured out in terms of their own investor base. That it's not just about capital gains. We all would want capital gains. But it's also the reliable cash flow stream that dividends provide. And that's why you have a wide swath of sectors today that pay out a dividend that didn't 5, 10, 15, 20 years ago.